It's that wonderful time of year where the world's greatest investors have to reveal what they owned on a quarterly basis. So now we're looking at September 30th, what some of the world's greatest investors own. Today we're talking about what did Michael Burry own at the end of the third quarter. We're looking at his investment vehicle, Scion Asset Management. What did he buy? What did he sell? He's selling on a lot of things and inadvertently may have revealed what is his largest position. I'll talk about all of this and more in this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right in so that way we can understand. But first, in full disclosure, this is not financial advice, and I may own interest in some of the securities mentioned in this publication. So diving in to understand what exactly happened in Dr. Michael Burry's portfolio during the third quarter, he's been selling a lot. I mean, that's really what this portfolio revealed. I mean, you can see a lot of these things. There's a lot of different sites where you can check on what he owns. I personally like the site Whale Wisdom. So he's been blowing out of a lot of positions. No more Facebook or Google call options. No more Tesla puts. No more options bets against U.S. Treasuries, the U.S. Treasury ETFs. No more Discovery stock, which a lot of people have been asking me to do a video on, thinking that was really cheap. There were just a few of the positions, and keep in mind, these are just a few of the positions that he completely sold out of. So he blew out of the vast majority of his portfolio. And so the question is, if he's selling out of everything, what's he actually buying? And the answer is not a lot. His largest position is CVS stock, and that, I believe, was one of the largest positions that he had previously. Previously, I think it may have been through options. I've done a previous video on CVS. I was very impressed with its shareholders' yield of nearly 10%. That struck me as quite interesting, so I'd recommend you check that video out just because it does strike me as a very reasonable valuation. It's interesting to see his new positions, including Lockheed Martin. So three new positions that I'm looking at: Lockheed Martin, or LMT, which is a defense stock that benefits from rising geopolitical tensions, maybe selling more Joint Strike Fighter jets. Distribution Now, which is an oil parts distributor, and Synexis, which is a teeny tiny microcap, somewhere around $100-200 million market cap, that jumped 30% on the news of his purchases today. So what's the takeaway, or potential opportunity for investors to glean from his portfolio as you're looking at all this? First, I think it's important to have actually some context on Michael Burry as depicted by Christian Bale. He, in the movie The Big Short, he supposedly made more than $100 million from his bets anticipating the great financial crisis and the housing bust. His net worth is rumored to be around $300 million. In my opinion, no matter what your opinion is of his recent bets, shorting Tesla, then getting out of it, or, betting against Cathie Wood and her ARK funds and then getting out of it, no matter what your opinion is there, I think based on his history of looking at various different companies, and you can see his prior write-ups, he's arguably one of the greatest analysts of all time, finding very asymmetric risk-reward and attractive bets. So the assets under management for Scion Asset Management, which is the vehicle he manages, is also over $600 million. So his personal net worth's rumored to be around $300 million. The assets he manages around $600, so maybe half of that's his own, versus the long securities that he's reporting. So the securities that he owns, like the CVS, like Lockheed Martin, LMT, or CVS stock, that's around $40 million versus $600 million in assets under management that he's reported. So unless he owns a lot of private equity, foreign stock, or derivative positions that he doesn't have to report, I'd argue his largest position is likely cash. And perhaps this shouldn't be terribly surprising, as he's tweeted several times recently how valuations are so rich, a 50% plus crash wouldn't be surprising. And he's even called out the current period as having worse speculation than the 1920s. Keep in mind, that was before the Great Depression, and more overvaluation than the 1990s, which was the tech bubble where the NASDAQ ultimately crashed 80%. Now, he did link to an article on Rivian. RIVN is a ticker, an electric truck maker that's tapping into this hype, saying, hey, EV vehicles are obviously here to stay. But here it is. Rivian is a company that has zero revenues and worth over $130 billion market cap. That is just exceptional. That's investors baking in a lot of growth assumptions, and I think that taps into exactly what he's talking about. That's a perfect example of potentially excessive speculation and excessive valuation that could potentially lead to just terrible drawdowns. It's in one scenario you could easily see Rivian dropping 99% based on this valuation, based on this sort of speculation. He's also called out that he's never shorted any cryptocurrency and that he's learned a thing or two from the last two bubbles. This implies he knows how crazy or stretched things can get. So it's sort of like recognizing that musical chairs can last longer than folks expect because you don't know when you're going to get that last song. You're going to get that last, tune, and then everyone needs to scramble to find a chair. And one possibility that he does allude to here is that he does potentially have a large short against 30-year U.S. Treasuries, which currently yield 2% while inflation is over 6%. He's saying, look, I've learned a thing or two. 30-year Treasuries, on the other hand, talking about, bubbles. I've never shorted cryptocurrency. Treasuries, on the other hand, that does make me think, yeah, he's probably shorting Treasuries. But once again, the main takeaway here seems to be that cash is possibly his largest position. What are my personal takeaways? How am I considering this as I, approach my own personal investment portfolio? First, a quick plug, where if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So once again, if you're interested, go to unrivaledinvesting.com, click join the journey. And if you enjoy breakdowns like this, as well as, detailed videos on potentially exceptional companies, make sure to hit the thumbs up and subscribe button. So what are my personal takeaways, as we're looking at all these? And so here it is. I'll just talk straight to you. First of all, looking at some notes that I quickly jotted down. So first of all, the main takeaway from this is have some liquidity. I mean, that's definitely something that if this is what Michael Burry's doing, he's arguably one of the best analysts out there, and he's having trouble finding incredible bargains, maybe it makes sense to trim a little bit of everything or make sure that I have a lot more liquidity in the event that there are incredible bargains in the future. So that is one possibility. Another aspect is like, okay, maybe I want to make sure my portfolio is concentrated in what I think could potentially be the best risk reward plays out there. So if something doesn't have crazy risk reward, maybe take away the capital from it, reallocate to the things that I think have more of an attractive risk reward. And at this point, given where my portfolio is invested, I think any additional dollar that I personally want to invest, I'm probably going to say, hey, it needs to have a minimum of a 200% potential return over 5 years. So that might be something that I'm thinking about. And I think the third key element, I think there are three big takeaways. So more liquidity, think about what your liquidity could look like over the next few years. Think about the risk reward, make sure it's an attractive risk reward that you're looking at for everything that you're potentially holding. And the third, I think a key component that I'm, considering and reflecting on from this is that maybe you should start thinking of everything through a full cycle. And normally, I do that with all my potential investments, but maybe it's worthwhile to put a little extra effort on this. There's a great book thinking about capital returns that was written by the folks at Marathon Asset Management that talks about how capital cycles fluctuate and what are the best things to hold at different points in the cycle. But it is probably worthwhile to consider that what does your favorite stocks, how do they do? How do they perform in periods when things aren't going well? Because right now, arguably, the economy is running quite hot. What if things start cooling down significantly? And so maybe you want to make sure you find things that are going to do and perform well regardless of what you're looking at in terms of the environment. For example, I recently called out my potential multi-bagger exclusively for Journey subscribers, where it's a company that trades at a 30% discount to book value. It has a long history of conservative management, a long history of beating the indices. So conservative management meaning they're prepared for a potential market crash. They're preparing for it. They've actively called it out. And it's in an industry that's going to be required year after year. And so it's not going to be going anywhere if there's, let's say, a recession or depression. This is a fundamental good or service that's needed. So think about it that way. Maybe advertising businesses that everyone are gung-ho about, maybe that's the type of business that, that could come under pressure. And that's something I want to definitely think about a little bit more from my portfolio. Find the things that are necessities versus the discretionary items. Maybe, tweak the portfolio around that. So with that example of a potential multi-bagger, it's also a type of company where I'm like, yeah, does it meet that critical risk reward profile that I need to have in this environment? And it's like, yeah, if you get some sort of re-rating, if you get some sort of, continued compounding with the business, you could potentially get, 200 to 300% upside over the next 5 years. So that does sort of check all the boxes. But everything else, I definitely want to think about, given this type of environment that we're in, where Michael Burry's calling this out. Now, no one knows when the music stops, and that's the challenge. And I'd argue a lot depends on the leadership of the Federal Reserve and what they choose to do in response to inflation and what they choose to do in response to the economy. But overall, I look at this and I'm saying, look, if Michael Burry, who's arguably one of the greatest analysts in the world, is saying, hey, I'm dumping almost everything to put on more and more cash, that is a point that is worth considering. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching.